Welcome, and thank you for joining us today. My name is Larry Karp, a proud 1987 graduate of Boston University Questrom School of Business. I am a university benefactor and have been involved for a number of years as a donor, volunteer, and event participant. And it is my great pleasure to introduce today's webinar, Financial and Economic Outlook 2021, presented by the BU Alumni Association. Our featured speakers are distinguished alumni who are experts in their field. First, Darrell Cronk, CFA, president of Wells Fargo Investment Institute, is also the Chief Investment Officer for Wealth and Investment Management. Darrell earned a master's degree in banking and financial services management from BU's Metropolitan College in 2006. Next, Michelle Meyer, head of US Economics at Bank of America Global Research, who Michelle earned a dual degree, that's both her undergraduate and master's degrees in economics from the College of Arts and Sciences at BU in 2004. And finally, moderating this discussion is Larry Kotlikoff, a Boston University professor of economics. Alumni are joining us from all over the world. And to give you an indication of BU's reach, today's audience is dialing in from more than 31 states and 12 countries. Major metropolitan cities represented include Boston, New York, Chicago, Los Angeles, London, Shanghai, Jakarta, Milan, and Rio de Janeiro. Thank you all for participating. Special thanks to our donors who make programming like this possible. Before we get started, I have a few housekeeping notes. Today's presentation is being recorded and will soon be available for on-demand viewing on the BU Alumni Association webpage. You will be sent a link shortly after the program has concluded. Also, Darrell, Michelle, and Larry are looking forward to answering your questions at the end of the discussion. However, please feel free to submit your question at any time using the Q&A box, which can be found by hovering over your screen, locating the Zoom toolbar, and selecting Q&A. It is now my great pleasure to turn the program over to our moderator, Larry Kotlikoff. Enjoy the conversation.
Thank you, Larry. It's a great pleasure to be with everyone here. I want to thank Darrell and Michelle for speaking with us today about the economy, how they see it. They're both, as you know, as you've heard, graduates of Boston University, and speaking on behalf of the faculty and maybe the administration, if I can go that far, I want to say we're very proud of both of you for your incredible achievements in your careers, and very eager to hear what you have to say about the economy. So let me turn to the first big question that's on lots of people's mind. Has to do with the stock market. You know, is it going to keep going up? Is it nuts? Is it disconnected from the economy? What's your thinking, Larry? Michelle, why don't you go first?
Sure. Thank you, Larry. It's great to be here. It's great to be able to spend some time with my friends at BU. So thank you. Thank you for the invitation. It's a great place to start. I mean, clearly anybody who's watching the markets see this, kind of almost exponential rise in the stock market. And it happened throughout 2020, despite the economy being hit by a pandemic, by an unprecedented shock that created major dislocations to the economy. So the question is, why? Is there a divorce between the stock market and the real economy? And I think part of that gap can be solved by both monetary and fiscal stimulus. The unprecedented shock to the economy was met by an unprecedented response from fiscal and monetary policy. Specifically, the Federal Reserve cut interest rates to zero very early on, before it was even clear what the pandemic actually meant for the economy. They started to expand their balance sheet dramatically, and they are still doing so. And they're on pace by our calculations for the balance sheet to be about almost 50% of GDP by the end of the QE program. And on top of that, they really embraced the idea that the Federal Reserve will be both the lender and the buyer of last resort, putting in place 13 different credit facilities using their balance sheet as a tool to backstop the markets. So once, and Darrell can talk more about this in terms of how it actually, he saw the market behave and trade off of these facilities. But from my perspective, it looked as though, the Fed announced the credit facility, they announced the muni facility, and upon announcement, you saw a positive reaction in markets. So in the end, the Fed didn't actually have to do very much in terms of deploying capital. It was simply the fact that the Fed was there as a backstop. And that is extremely powerful. And I think that helped to really lubricate markets and make sure that liquidity remained in the financial system. Adding to that, of course, was the fiscal policy, which was extraordinary. Accounting for this latest round of stimulus, which was passed in December, there's $3.7 trillion have been pumped into the economy from fiscal stimulus. That makes up over 17% of GDP. And so even though the private economy, the private sector was struggling from the pandemic, there were displaced workers, there was a large part of the economy, the services part of the economy that was effectively shut down for a period of time, there was sufficient offset from fiscal policy in the end. And I think that really has led to some pretty impressive returns in the stock market.
Cool. Hey, Darrell, that's great. That's very interesting and informative. Darrell, do you want to chime in on this one, or do you want to take the next question, which is the impact of the second wave of COVID on the economy, and how you see the economy doing through 2021?
I can take both. I think Michelle and I should maybe comment on the second one. Let me just maybe add to, I thought Michelle's comments were spot on the extraordinary monetary and fiscal policy support. Probably the most frequently asked question in calendar year 2020 was, why is there such a divergence between Wall Street and Main Street? I would just point our listeners to maybe four things. One is there's a timing difference, right? So the stock market is, of course, a discounting mechanism and tends to run ahead of the economy. If you go back and look at charts, the S&P 500, for example, troughed about 3 months prior to GDP, and then obviously let out faster than the economy does. There's a composition difference that is not insignificant. So the sector composition of the S&P is quite different than the drivers of the economy. For example, the S&P benefited materially from the work at home trade, tech, communications, discretionary. In fact, if you looked at technology, media, and telecom, they make up 35% of the stock market capitalization of the S&P 500, but they only account for 8% of the GDP contribution. So there's a wide divergence there, as tech, media, and telecom did really well. Two more I'd just quickly point to on this question. There was an exogenous shock, right? So we shut the economy down. You could argue almost a global stoppage of economies. We never shut the capital markets down. There was concern that liquidity impairments would be there, but therefore, the steady state of capital markets continuing to move through that probably got ahead of the economy and started to lead out in front of the economy. And the last thing I would just say is there's a sentiment difference. And so there's drivers that are affecting the stock market and Wall Street that aren't necessarily as quick. And Michelle said it well, I think, with a lubricative effect of some of the blunt force instruments of monetary and fiscal policy. So some of those things, of course, would be things like credit spreads having tightened in a risk-off scenario, commodity prices are moving higher, the US dollar has weakened, all of which are, big, strong tailwinds for the stock market and kind of pushed it through faster than the economy.
Great. And Michelle, did you want to, what about the second this year? What are you forecasting for this year?
So I would just say, Michelle and I were talking about this in the room. We have a little side bet, it sounds like, going on. So both of us think the U.S. economy and the global economy will have a nice rebound and snapback effect. We have 2021 U.S. GDP for the calendar year at 4.7% growth and global GDP at 5.5% growth, both of which are boomy numbers by all accounts for the last decade. And I think you have to remember that both the U.S. and the global economy contracted in calendar year 2020. The US economy contracted the most it had since calendar year, I think, 1946. So some of that's a baseline effect, of growth coming back. But we do think that the US economy retakes the high water mark of basically 2019, early 2020 GDP numbers sometime later or late this year. And I know Michelle's got probably more intelligent things to say from her economics background on this than I do.
Go ahead, Michelle.
Yeah, no, I would very much agree with you. I think the economy is well positioned to see continued growth. And as you noted, we were chatting about this, and we're even more bullish. We're looking for 6% GDP growth this year, and it's not hard to achieve in our view, provided that the virus is under control by around the middle of the year. So there is this race between the virus spread and the vaccine. The path of the economy is highly dependent on that. So if the coast is clear and people can re-engage in activities that they hadn't been able to, we think that gives a really strong foundation for continued economic growth, and really driven by the consumer that has a lot of purchasing power out there. By our calculations, there's a whopping $1.6 trillion in excess savings. It's a remarkable amount of money because of stimulus, because of unintentional savings that happened as a result of a forced kind of rotation in the consumer basket. So yeah, we are pretty bullish, again, provided that the virus in the end of the day is at a low enough level to let people re-engage. But I do want to make one more note on the stock market, and I'm gonna, if that's okay, Larry, I'm gonna throw this back to Darrell. But
Sure.
There's a lot of questions now about financial stability risks and potential bubble-like behavior in parts of the market, and specifically when you look at all the kind of the retail frenzy, may you say, in the market. Are you, how do you judge that? How do you value that when you think about this divergence between the stock market and the real economy?
Yeah, it's a great question. I would say we're not really seeing it. If you adjust for inflation and interest rates, right? Let's all admit that a 21, 22 price earnings multiple is high on an absolute basis by almost any historical count. But if you adjust for inflation and interest rates, by our math, we're showing that the stock market is about at 3 to 5% expensive, or at a premium relative to kind of fair value. So it's not something that, we're jumping up and down concerned that it's going to be, materially problematic. I do think what people are missing potentially in this, and be interested in your thought here, Michelle, but, we have, when you look through, for example, the idiosyncratic issues that happened last week around retail trade participation in some of the Reddit stocks, you really do have a uniquely bullish backdrop for risk taking that's setting up. It's what we kind of call a powerful macro mosaic, where you've got a weakening dollar, you've got rising commodity prices, you've got a strong global equity tape, you've got tightening credit spreads. Outside of last week, you've had, for the most part, collapsing equity and bond market volatility. You've got negative real yields. You've got a 10-year at about 1.1%, and you've got this big, and you hit this on the head, Michelle. You got this huge fiscal stimulus coming in, and what we thought was going to be potentially a fiscal drag in calendar year 2021, with the Biden win and the Congress being full Democratic using reconciliation, looks like it's going to be a fiscal tailwind after all, not a fiscal drag. And then you put that with better vaccine news. We actually think the market, with all that excess liquidity you referenced, could power nicely higher this year, which will, I think, surprise a lot of people.
Okay, let me ask about another part of the economy that most people live and work in, which is the small, medium-sized companies, restaurants, movie theaters, you name it, taxi cab drivers. What fraction of these companies do you think are zombies at this point, will never recover after the Fed stops making loans to them through different vehicles that it's set up?
Michelle, why don't you take that from the small business side, and then I'll maybe add on some comments around the public markets.
Sure, that's great. So the survey data we look at, and we actually rely on a company called Homebase, which has done a great job at giving us kind of real-time intel on the small business community. The survival rate pre-COVID is about 80%. So about 80% of the small businesses that were around prior to COVID are still here with their doors opened, which means that certainly there was a certain amount of pain felt in the small business community, which was not lost on politicians, given, as you noted, Larry, the support from the PPP loans, from the Main Street lending facility, from the Federal Reserve. There's a real emphasis on helping small businesses, given that they don't have as much capital to rely on to get through the difficult times. And their sector composition tend to have more restaurants, retail sector, which was disproportionately hit as a result of the pandemic. But that said, it's been quite steady right around those rates for the last, call it 9 months or so. And that, I think, is a good sign, despite the second wave that we had seen in the pandemic, in the virus curve, right, which hit us all, across the country throughout November and December and into early January. You didn't really see incremental small business destruction. The numbers kind of stayed the same. So you had the initial level shift down when the pandemic hit in the spring, and then it's been fairly stable. And the hope is that with the low cost of capital, with demand coming back, you will be able to see new business generation and formation that maybe in the end, again, to take a half glass full interpretation, might be, might allow for more efficiency gains or productivity, because maybe the new businesses that are created bring a new level of innovation for the economy. But yes, clearly there are displacements, and we don't want to, look past the fact that there were a large part of the economy and a lot of individuals that were hurt very, very much from the pandemic.
Yeah. Well, Darrell, what do you think?
Yeah, so let me take it from kind of a public market standpoint. I'd make 3 points here. One is, people use the term zombies. So let's just define what zombie means. Zombie typically, at least from a Wall Street definition, means a company that doesn't have sufficient operating income to even cover its interest expense or interest on the debt that it owes, is kind of the Wall Street definition of zombies. So if you take a broad swath look of that and use like the Russell 3000 index, in 2020, 739 companies, so about a quarter of the index, would fall into this zombie category, which is quite high. You could even argue alarming, right? Recall though that there was a big profit dive in 2020 that probably isn't sustainable, as Michelle and I have been talking about. So that 2020 kind of needs to be normalized. If you went back to 2019, that number of companies would be just over 500 companies out of the 3,000. But collectively, the debt that those 739 companies owe has basically doubled from about $1 trillion to almost $2 trillion. So there is, concern there about high levels of leverage on the balance sheet and being able to support that. The most acute problem likely is in small cap companies, Russell 2000, where there's about a third to 40% of the index today doesn't turn a positive profit or has negative operating losses. It's interesting, point 2, and quickly point 3 on this is, point 2, when you break it down by sectors and you say, where do those most prominently exist? Almost 50% of your zombie companies reside in 2 sectors, in the healthcare sector and in consumer companies. The healthcare sector often has a high amount because it runs a big degree of biotech companies that don't typically turn a profit and are often that way. So we need to watch the consumer companies, which are about 21%, and healthcare is about 28, adding up to almost 50. It's what percentage of those consumer companies come back. I think we want to have our eyes most closely fixated on. And then the last point I would make, and Michelle kind of gracefully glided by this, but let me put an explanation or an explanation point on this. What is different about this recovery this time is that than prior recessions or bear markets or exogenous events for the economy, is that we didn't have the kind of financial excesses heading into this recovery. This was truly a healthcare emergency, a heartbeat stoppage of the global economy. So it isn't the 08-09 crisis where you had housing excesses at the level you did. It isn't the 08 or the late 90s crisis where you had the kind of tech bubble that we enjoyed. The takeaway from that is when you walk into a recession or a bear market without those excesses, oftentimes history teaches you it's a faster recovery coming back out because you don't have to work through all those excesses which have a long tail event on them. So there is reason to believe that the recovery this time, and we've already seen some of it, could be swifter and faster because we're not working through all those financial excesses.
So you both seem pretty upbeat. I just want to, I'm an economist, so I'm not supposed to be upbeat. That'd be dismal. So I want to try and bring you back down the other way a little bit. So one concern I have with the Fed is that, and we have these zombie companies, and maybe we have some other near zombie companies, big corporations, smaller companies, is whether the Fed can really raise interest rates, whether it's stuck keeping interest rates down for are they kind of locked into keeping these companies afloat for the long term? And then connected to that is the whole issue of how you see us coming out of this recession. I know, Michelle, you think we're going to have 6% growth of B of A. Bank of America believes that. But we had a pretty slow recovery in 2010 after the Great Recession. Do you see any similarities about that? Are we going to repeat that slow recovery experience? But yeah, obviously you're saying no. And Darrell, you're also saying no to a little lesser extent, but what makes this time different? And how does the Fed get out from under all the obligators that all the people that are all the companies that are basically feeding at its trough? How does it cut off the umbilical cord?
Michelle, you go first.
Yeah, I'll jump in. So I think there's a few distinct differences between this cycle and the last cycle. And Darrell already touched on it, but I'll just kind of emphasize the household balance sheet today versus back in 0809. So the great financial crisis was a balance sheet recession. You had excesses of the financial system and you had excesses in the household balance sheet. Debt levels were way too high. And as a result of a repricing of a very large asset on balance sheets, which was the home, there was forced deleveraging that had to happen. So the household sector had to clean up their balance sheet. And as they cleaned up their balance sheet, the economy had to grow effectively below trend for a period of time, right? Because they were reducing the amount of leverage in the economy. The exact opposite is happening now. The household balance sheet was extremely well prepared for this shock. Debt levels are back. The financial obligations ratio is back to, 1960s levels, beyond because of low level interest rates. But even debt as a percent of income is back to early 90s levels. Household wealth is extremely high. Now, granted, that could adjust, of course, with adjustment in stock market and home prices. But for the most part, the household sector is in really good financial space, again, on aggregate, which means that when they were faced with an income shock as a result of the pandemic, it didn't ripple into a debt event as well, right? And I think that's important. And the other point when it comes to debt and to leverage is also on the public side, right? In the great financial crisis, yes, it was met by the American Recovery Reinvestment Act, the ARA, which was just under 800 billion. That looks like pennies now relative to what they're throwing in. So there was a much less stimulus, much smaller willingness to continue to put deficit expansion in. And in fact, if you recall, we had the sequester back, 2 years after the recovery started, and a pretty significant debt reduction program in the US and globally when the economy was still very fragile. So you have the household balance sheet reducing debt, you had the public sector reducing debt, and as a result, the recovery really was quite wobbly. And that's the opposite today, right? You have the private sector, the household balance sheet, where in theory, there's plenty of room to take on debt if they desire to. Cost of capital is very low. And there seems to be no desire for, there are no fiscal hawks in Washington. Try to find one. So deficit expansion seems to be the name of the game, and that seems like that will continue for the next near term. So I think that makes it clearly a different set of events for the recovery. I would also just reiterate the cause of the recession, as Darrell noted. this was a purely exogenous event. It wasn't a recession that was brought on because the economy had overheated too much and needed to correct. And in fact, a lot of measures suggested we were still under capacity in certain areas, like housing, for example, where the housing stock was still too low. Even the capital stock was probably too low, so we didn't really have much overinvestment or overexpansion in the economy, which meant that you didn't have, again, as big of a need to correct on the downside or as persistent of a correction on the downside. So I think those are pretty important distinctions. In terms of the Federal Reserve, that's an excellent question. And it gets to the point of what is the Fed's ability to actually normalize policy? They tried throughout the last cycle, and in the end, they realized that there's a real limit to how high interest rates can get. And there's even a limit to how much they can shrink their balance sheet because they started to face some reserve issues in the banking sector. And I think on the back of that, this Federal Reserve has really embraced a low for long policy. They changed their framework to adopt basically a make-up inflation strategy. So they want inflation to run above 2%. And they would rather lean in the direction of keeping rates too low for too long than hiking too early and potentially curtailing the recovery. But Darrell, over to you, specifically on the interest rate question, because I do struggle with how high rates can get before it becomes problematic for the financial system. I think that's a really good question.
Yeah, it is a good question. It's one we get frequently. I'm sure you
Yeah.
do as well, Michelle. Let's just probably all agree that unless something happens, unless we get a shock to the economic system, unless we get a true inflation scare, right, or we get a retrace back into recession, that rates aren't going anywhere for a long period of time, at least on the short side of the curve. The debate on the fixed income markets is not about will the Fed raise rates anytime soon, because as using the Fed's vernacular, they will say we haven't even begun thinking about raising rates yet, right? So the real question on interest rates is how steep can the yield curve get? How much can intermediate to long-term rates, so think 10-year, 30-year Treasury, go up? You should know, the 10-year today at 110 on September 30th this last year was 68 basis points, right? So we've gone up nicely in a short period of time. The question is why, right? Well, if you think about intermediate long-term interest rates, they're really functionally made up of three things. There's a term premium of interest rates, or a length of time on your term premium. There's an inflation premium and a growth premium. Interestingly, the rise in intermediate long-term rates has almost coincided perfectly to the basis point with the rise in inflation expectations. So even though growth is going higher, inflation expectations have been the majority of the movement in the curve over the last 5, 7, 9 months. And so we think the curve can actually steepen even more. I'll just finish, Larry, and say I'll take your bait really quick, right? Because you said we were a little too bullish, a little too optimistic. So two things that do concern me coming out of this recession, and Michelle's exactly right. The wealth effect through high 401ks, high home prices or home equity, nationally looks great. But obviously when you get below the surface, this recession, more than anything else, exacerbated inequality, right? I mean, the National Bureau of Economic Research says the wealthiest 10% of households in the United States control 84% of total value of stocks, bonds, trusts, business equity, and over 80% of the non-home real estate. So that wealth inequality, looks good at the top level, but underneath has only diverged more between the haves and have-nots. And that's a problem for us as an economy. We need a healthy middle class long-term to be successful. And then the second quick point I'll make, taking the bait of, what's not optimistic here, is recessions often lead to permanent labor force displacement. And we think that's probably going to happen, right? You get coming out of a recession, as the dynamics change, you end up with a labor force that the economy changes on them, and they're not skilled or educated to change as fast as that does. And so you create an air pocket of the labor force that just kind of permanently gets displaced, if you will.
Well, I have to say, we have two fantastic graduates of Boston University have given us lots of wisdom and facts and food for thought. Let me just be a little bit more add a little bit more pessimism to this because I'm sure we've had quite the right balance, a full enough balance. But if you look at it, and this goes back to the issue of interest rates, long-term rates, and Fed policy, the Fed has increased the base money, how much money is just printed out, and part of that money creation, called base money creation, is the result of the Treasury borrowing money, taking in money and buying chickens for the president's lunch. The money goes to Darrell, who sells the chickens, and then the Fed, Jerome Powell, prints up money and gives it to Darrell in exchange for his IOU. So now what's happened is that the White House has gotten the chickens and the economy's gotten more money, more paper money. So we have an increase in the base money by a factor of 800% increase since 2010. We've had an increase. Now, a lot of that money the Fed thinks they're going to get back because they've used it to buy private securities, like make loans to companies, and they think the companies are going to pay back the money. So the money's going to come back to the Fed that they've put out there. But whether or not they'll actually be able to do it is, depends on how many zombies we've got and how things turn out. But even ignoring that issue, the actual M1 money supply, the basic money supply measure has gone up by a factor of 400%. And the price level since 2010, the price levels have only gone up by 20%. So we've got this huge disconnect in the post-2010 period of just massive increases in money supply and not producing an increase in prices. And so, if this were happening in another country like Argentina, we'd be having hyperinflation right now. And if we got back to kind of the relationship between money and prices that we had in 2007, we would have hyperinflation right now. So that's, I don't know whether you guys need to answer this or respond to it. I'm just laying that out there as a factoid that I find pretty shocking and concerning about if we keep going down this path. We've had also the concern about federal debt. Federal debt's gone from 30% of GDP or about a third of GDP in 2010 to now over 100%. There's going to probably be 116%. If you go back to 2008, we're looking at the Italian debt to GDP ratio was about 120% of GDP. And we thought, oh my God, Italy's totally broke. So we're in that kind of position. Meanwhile, China's been surging ahead without any COVID problem. And who knows what their kind of fiscal situation is. Anyway, I just say that I think we've got a couple questions. Let me throw and invite other people to type in questions, and then we'll just open it up for back and forth between the three of us. So we have Alice Bresman here wrote, what impact do you think the current proposed stimulus package will have on our economy short and long term? So Michelle, why don't you take that away?
Sure, of course. That's a great question. Before I address that, I just want to say one quick thing to Larry's doom and gloom comment. So I think, look, those points are valid, but there's a question over the short versus long-term narrative. What you laid out is actually quite bullish from the short term because you have deficit expansion and you have a lot of money in the system, but you're absolutely right. There could be and probably will be long-term consequences. And a critical factor is there whether or not the US remains the reserve currency. So that's just one quick thought there. But in terms of the stimulus, so the Biden administration economic team is proposing 1.9 trillion additional fiscal aid. Depending on the news headlines at any minute, you're going to find a different part of the negotiation. But our view is that they may settle on something close to $1 trillion. The question is whether it's done through a bipartisan effort or if it's done through budget reconciliation and a simple majority, but there will be very likely more stimulus passed in the spring. And it will be passed in an environment where, the economy should be all else equal on an upswing or starting that process of an upswing. So it certainly is a really nice tailwind, and that's critical in our forecast for 6% growth this year. We are assuming more fiscal stimulus. If we don't see that, then our forecast won't prove to be accurate, right? We would see slower growth. So the stimulus is, of course, an important part. And when you think about the multipliers of that stimulus, it depends what's in the package. There's talks of another round of checks, maybe more targeted checks, which would be good because you have a high propensity to spend if it's more targeted towards those that are most of budget constrained. Extend unemployment insurance makes a lot of sense. State and local aid, and then of course a response on the health front as well. But the feed through the economy will depend in part of the composition.
Great. Darrell, did you want to pipe in on the issue of stimulus and the economy?
Well, I think Michelle hit it. I think people underclub the idea of how much fiscal stimulus is in the engine right now. And Michelle went through this earlier, but let me just accentuate that point. For the better part of a decade through the last cycle, you'll recall Fed Chair Janet Yellen pounding her fist on the table, saying monetary policy can't be the only stimulus and the only help to the economy. We need fiscal help. Well, fiscal health cometh, right? It came from reasons that we didn't expect via the pandemic. But, if you just go back in the last 11 months, it's February now, we've had a $7.7 billion package, a $192 billion package, a $1.8 trillion package, a $484 billion package, and a $900 billion package, all of which have already passed, right? And the $900 billion package passed at year end. Only about a third to 40% of that has already been spent or appropriated. So there's still a bunch more of that package that hasn't even been spent. Now enter 1.9 trillion, right, proposed under Biden's rescue plan. I agree with Michelle. I think the final number is around 1 trillion. The interesting thing is the less bipartisan cooperation, the bigger the number probably becomes, because the Democrats will go their own way through the budget reconciliation process. And so, if you can get more bipartisan cooperation, it probably narrows that number down to a smaller amount. Regardless, any way you slice and dice it, you've got somewhere in the neighborhood of probably $5.5 trillion of stimulus, if you include the trillion coming this year, that's been injected in the economy in the last 11 to 12 months. That is 25% of the GDP. It has unprecedented, economic impacts and capital market impacts. And so I think you have to understand it for what it is. The flip side of that, to Larry's good point earlier, is it has people concerned about, the budget deficit and then the national debt, right? Both of which have been going up at rates that none of us should feel good about. The important point of the debt, though, if you take out, and I don't mean to get too nuanced here, Larry, but if you take out, so the national debt today in total is $28 trillion. About 8 trillion of that is intra-government debt. So think Social Security trust funds, meaning the government owes it to itself. So that's down to 20 trillion. And then the Fed balance sheet is 7.4 trillion, of which about 6 trillion is treasuries. The rest is mortgage-backed securities. So you got to take off the 6 trillion that's owed by the Fed to Treasury. So now you're down to basically $14 trillion owed to outside creditors. Think China, think bondholders, that type of thing. I think that's the number you need to think about in a debt to GDP. So 14 trillion on a 21, maybe $22 trillion economy, all of a sudden doesn't look as alarming as.
Yeah, let me just pipe in here on that one, Darrell. So if you look at the CBO, the Congressional Budget Office, debt in the hands of the public, that was 33% of GDP back in 2010. Now it's over 100%, and this nets out the treasuries that the Fed buys from the public, and basically hands back to the Fed. The Fed hands back to the Treasury. So you've gone from a third of GDP to 100% of GDP. We're heading to 116% of GDP. This doesn't count all these unfunded off the books liabilities like Social Security, whose liability went up $10 trillion last year. If you look at table 6F1 in the trustees report of Social Security issued last April, it went up by $10 trillion. It's now up to $53 trillion. So basically, we've got 53 trillion versus maybe 22 trillion of official debt. We've got 53 of this unofficial debt just for Social Security. And then we have all the liabilities for Medicare and Medicaid. So I would say the country is actually broke. There's a comment here from Anilia Blanco. She says, as an Argentine, I'm with you, Laurence Kotlikoff. I also like Darrell, Cronk, brought up the fact of inequality and unemployment. So and we do have a basis for being really concerned about
I
this
agree.
policy and it's a post-war process of taking from young people and giving to old people. And now this is a perfect excuse in this pandemic not to take from the rich and give to, we have to give to the poor, but you could take from the rich and give to the poor, but we're taking from our kids to give to the poor.
Yeah.
Uh, yeah.
The one thing I would say here, and Michelle, you should weigh in here too, because I'm sure you have an opinion. I often bring this conversation back because I think we can parse a whole bunch of numbers and look at this into, okay, well, use the Argentine example. What factors, what risk items should we be watching for when, for example, the capital markets, right, which is where treasuries are issued and priced, tell us that we have a debt problem, right? So think Argentina, right? Well, the issues you want to watch for anytime a country has a sovereign debt problem is their fiat currency, right, would devalue or debase naturally. Their interest rates would go up, right? Term structure of rates would go up because obviously it would cost more to finance their debt internationally because the credit risk naturally goes up. And you would see some kind of inflationary spike, maybe, I don't know if it's hyperinflation or whatever nomenclature you want to put on it. None of those three conditions today are our problem. I take your point, Larry. They may be our problem 2 years, 5 years, to Michelle's point, 10 years from now. But today, the Fed's trying to get more inflation, not less inflation. The dollar has been strong for years and has just recently started to tail off. And interest rates are at generational lows. So I think
just one quick response on that, which is that if you look at the policy, had the Fed not intervened, we would have had probably huge financial collapse. We would have had major banks fail and smaller banks. We would have had probably deflation. So relative to that scenario, the no intervention scenario, what the Fed has done has led to not inflation, but to a significant increase in prices relative to that scenario. So I think you have to keep
fair
the baseline in. So I think the Fed, it's not the case that the Fed's policy has been benign, hasn't had any impact on inflation. I would say it's just that it's very hard to see it because we're not thinking through the counterfactual situation.
You're right.
But anyway,
That's a good point.
Yeah, a couple of questions have come in about inequality, and maybe Michelle, you want to take this, the impact of inequality on the recovery, how that might impact particular sectors, perhaps, or the overall recovery. The fact that some people, as Darrell pointed out, may be permanently displaced in terms of a job, and their wealth has been run down, whatever that wealth, and we know a lot of people have very little wealth to begin with. So how do you see that? You're saying we've got all this unspent wealth, high saving of late, and but this may be in the pockets of people that are not going to necessarily spend it.
Yeah. So I think this is extremely important, and sometimes gets lost in the discussion of aggregate numbers. When we talk about overall GDP growth or overall labor market expansion, there's a lot that's going on under the radar. And I think in this cycle, more than we've seen in the past because of the nature of this shock. So the pandemic, disproportionately hurt the services side of our economy, leisure. And leisure tends to have workers that are paid less. So if you look at the job market for the highest income tier, jobs are even above the pre-COVID level, right? There was a little blip lower in jobs, and then it's more than recovered. But for under 40,000, those individuals earning less than $40,000 a year, you're still almost 50% below the pre-COVID level, right? So there's huge differences in terms of how people are faring through the cycle, depending on where they work and what their income is. And as a result, that has certainly widened income and wealth inequality, which is a real problem. And it has led to this description of the recovery as a K-shaped recovery. Why is it a problem? So Larry, as you point out, when more income and wealth is concentrated in fewer and fewer hands, less of it makes its way into the economy. More of it is kind of sits in savings or passed on from generation to generation. So aggregate consumption will be lower. potential growth rates will be lower. When you think about these trend growth rates, et cetera, that will all be damaged as a result of income inequality. We'll see what happens in the next year or so. I think the hope is that monetary and fiscal policy was able to bridge the gap for this portion of the economy, at least some extent, with stimulus. And that when demand returns for these activities, services, leisure, they'll be able to bring back their workers. They'll be able to pay their workers more, and they'll be able to, over time, make up for some of the pain that was made here. So we'll see how that ends up playing out into the second half of the year. We'll see how it ends up playing out into 2022 as well. Again, as the consumer re-engages in these activities, and I think it's really influencing both fiscal and monetary policy, right? I mean, part of the reason that there's talk of additional stimulus, despite all the money that's already pouring out, is because they're trying the best that they can to get money into the hands of those that need it most. And in a sense, it's just kind of flooding the system, right? Because it's very hard to make it as targeted as it needs to be made. Similarly, on monetary policy, I don't think there's a time that Fed Chair Powell speaks now where he doesn't mention inequality. And he doesn't mention the need for an inclusive recovery. And the fact that they're not just targeting the standard unemployment rate, they're targeting different measures of unemployment and underemployment. And they're targeting, the unemployment rate by different demographic groups. So I think that is a reason both that monetary and fiscal policy has been as supportive as they've had been, with hopes that it can address some of these inequality issues.
Very interesting. Let's see. There's a lot of talk about the Biden administration raising taxes. With the pandemic and economic uncertainty, the increase may be postponed. My personal concern is what all of you think about what will happen to capital gains taxes. Some people are retiring and selling investment real estate, and businesses are already faced with high capital gains taxes. Where will we go from here, and what other taxes may be increased over Biden's first year? Gary, you want to respond to that? I mean, Darrell, sorry.
Oh,
Darrell.
okay. Yeah.
Darrell.
So I do think there is, so I would sequence it in this way. I do think what you'll find is Biden has said that he wants to do what he calls a two-part plan or package. One is rescue, which is this $1.9 trillion worth of a stimulus, which probably gets done through whatever the number ends up being through the reconciliation process that we talked about. And then beyond that, or behind that, is a second package that's targeted towards intermediate and long-term growth. So think things like green infrastructure and energy, and things around addressing long-term secular trends of inequality that they want to invest in. Some of that will include infrastructure as well, the creation of jobs, almost like perhaps a Marshall Plan, of the modern 21st century. What will be probably buttressed with that second recovery element is some tax increases. We truly believe they will want to increase taxes. It's probably going to be focused, we think, in three places. One is you will see a proposal to raise corporate tax rates. Effective corporate tax rates today are roughly, on the large companies, about 21%. You'll recall that's down from 35% pre the 2017 tax reform package. We think it probably moves up somewhere between 25 and 28%. So from 21 to 25 to 28, in that range. The second important point that they're probably going to push on is raising the highest tiers of the personal income tax component. So something back, the top tax bracket today is 37%, returning it to 39.6%, which was pre-2017, and reducing some of the itemized deductions that are allowed through that. And then we do think kind of the wild card here is capital gains tax. We think they'll put it out there. It's probably, in our opinion, a 65% probability that you do get a raise in capital gains tax. The proposal will probably be to raise it back to something like federal income tax levels, which could be substantial for the wealthy, right? Taking it from a 20% range back up to as high as 39.6. We think it's probably going to end up being a negotiation tool in that back and forth. So you may see capital gains go up slightly, but probably not back to federal marginal tax rates. those will be the three big levers we think the Biden administration will try and pull around tax increases here in 2021. The last question they would probably, or you should ask as an investor or be thinking about, is there is precedence for making them retroactive back to 2021 if they could get that legislation done in 2021. And budget reconciliation at its core is really about passing spending packages and tax packages.
Yeah, let me just, there's another major aspect of the Biden. I think, first of all, the capital gains tax increase will probably only occur for capital gains above $1 million. That's what I've heard. Maybe I'm off on that. But the other part of the big tax part of Biden's plans is increasing Social Security payroll taxes for people earning more than $400,000 a year. That for marginal earnings above $400,000, he wants to tax those at the full employer plus employee 12.4% payroll tax rate. So for high earners, this would be a very significant tax hike. It wouldn't lead to them getting more benefits. They would just have to pay more taxes for Social Security. But Lord knows we need more revenues for Social Security, and this will. But he also wants to spend those revenues on increasing the minimum benefit for beneficiaries, increasing benefit levels for people that live beyond age 78, kind of across the board, but on a progressive basis, helping widows with higher benefits, helping people that worked in the public sector and are being kind of, in some ways, discriminated against under the Social Security system with respect to benefits they get on their own record. So he has some big plans on Social Security too, which could have a big impact on the incentive of rich people, high earners, to keep working, because they could easily be put into a 65% combined bracket. If we talk about Darrell's 39.6% reference to the federal tax bracket, then you think about a state like California might be in a 10, 13% bracket. Then you've got state sales taxes, and then you've got this payroll tax of 12.4% on top of that for high earners. And then you've got a FICA tax of 2.7% that's on everybody anyway. It all adds up to a pretty high number. It could easily be 65% or 70 cents on the dollar. And now we also have a lot of poor people who are being taxed 70 cents on the dollar. If they earn an extra dollar, they lose benefits worth 70 cents or more. I think that about a quarter of the poor people and the lowest 20% of the income distribution are facing marginal tax rates above 70%, a quarter of the poor people. So we're locking the poor into poverty. We may lock the rich into not working. We have to kind of figure out a fiscal system that actually gets more revenue, but gives people incentive to work at the same time. And this kind of brings me to my last question. I'll start with Michelle. We have about 5 minutes left, but I want to think about the long-term picture of the U.S. We've had these recessions are usually, and these problems we have with the economy are usually short-lived, a couple of years, and then the economy heads back. But is the economy on a long-term path of decline, at least relative to, let's say, China? And are we going to become a second-rate power? We know that from the UN, the demographic data say that we're going to be adding 2.5 more Chinas to the world population. The U.S. population is going to grow by about 100 million people. That's very substantial. But if we get immigration back online, but places like Africa and the Middle East and India are going to explode in terms of population, and also they're going to catch up in terms of labor productivity. So are we looking at a U.S. that's going to have, at the end of the century, the position of, let's say, Germany to the world, which Germany now has about 5% of world GDP? Are we going to end up with 5% of world GDP and be a second-rate player where the dollar is no longer the world's currency? How do you see this, or do you think it's going to be the American century again?
Well, I think we might have to leave this to be continued because I think the clock is running, and I see Larry Kotlikoff here ready to do his concluding remarks. But look, yeah, that's one narrative, and it's certainly possible, and some of the demographics aren't favorable. But I also think you have to remember, the U.S. economy has been dynamic. There's a lot of technological advancements. we still do have a global economy, and globalization is still here despite some of the things that's happened the last few years. So I'd like to hope that there's still, a decent path ahead for continued U.S. growth. But of course, as the economy ages, trend growth does naturally slip.
Okay, Darrell,
Yeah.
how about a final word from you here?
Yeah, just 30 seconds on that. I'll be short and sweet. So it's interesting. This comes full circle, right? I think the difference about your question about us remaining a competitive global power is really rooted in education, right? We have led for the entire 20th century as the education powerhouse. We've slipped behind, right? We haven't invested in education like we need to as a country. And I think that more than any other factor will determine our success or lack thereof in the 21st century. So all of you at Boston U, you have an important, vital job to do.
Yeah, absolutely. And
Great
well,
point.
hopefully this new technology, we can be teaching kids by Zoom at least half the day. And so we can make education uniform across the country and have poor kids receive the same education as rich kids because it's the best of the best, all just delivered electronically. That's my hope for the future of education and the maintenance of the U.S. Success story. So let me thank you both. It's just it's just terrific that we have graduates like you and graduates all over the world, really, who are leading the world in so many different fields. I'm just very proud to be at Boston University, and this is getting close to about 40 years now that I've been there. And Michelle was even an undergrad when I was chairman of the department, and she remembers my graduation speech. So
I do.
So
a
let me take it
big
from
honor to have that speech remembered. Anyway, you take care, and we're going to turn things over to Larry Karp for final words. Thank you.
Thank
Larry.
you.
Thank you.
Thank you, Darrell, Michelle, and Larry for this compelling and informative discussion. I enjoyed hearing your insights on the state of our economy and your take on the future of our financial markets. This webinar is very timely given the COVID pandemic and the current state of our economy. Thank you to our audience for taking time to join us today. You provided some great questions, so much so that the questions that I actually submitted, we didn't have time to get to. I also want to take this time to again thank the many donors out there who support the great work and valuable programs at BU. You help make this institution a rich environment for students, faculty, alumni, and friends. For that, we are very grateful. We look forward to having you join us again in the very near future. Keep an eye on the BU alumni calendar for upcoming events and check back as often as possible for programs as they are added on a regular basis. Take care, enjoy the rest of your day, and stay safe.
Thanks again, everybody.